This is the Royal Financial Investment Group. As always, this is your host, Prince Dax here, coming to you guys live from Japan. I'm actually in Sasebo, Japan right now, but that doesn't stop me, worldwide, coming to you guys with another great video. But I don't have a lot of time. I definitely know you guys don't have a lot of time, so let's jump straight into the topic. Today's topic is going to be a market crash and how to profit from it. So let me give you guys a little bit of a backdrop. We all know that anybody that's been following the market, or if you're brand new to the market, since around, we had a stock market crash around about 2008, which kicked off the Great Recession. You remember when the housing market and the automobile industry and all these other industries collapsed. And essentially, we had to stimulate the economy. And one of the ways you stimulate the economy is to lower interest rates. When you lower interest rates, that stimulates the economy because money becomes cheap, meaning that companies and banks and people can loan out money for cheap, right? And the reason why you want to loan out money for cheap is that when money is cheap, people tend to take more loans on it, and when you take more loans on it, people use that to stimulate the economy. Like they can pay workers, they buy stuff like that, able to employ more people. So that's one of the ways you can stimulate the economy. And also, you had a stimulus package where the Federal Reserve was pumping about $10 billion a month into the stock market itself to get the U.S. market back up. So now we fast forward to 2015. It's been a great run since around 2009. The bull has taken over. The market has been charging to record highs, which has been great for investors in that time frame. But the problem is we've had zero interest rates now for the last few years. So now you don't want to have a market going too high and for too long, right? Because that's not good. Because right now we have unemployment at an all-time low, right? And we have when unemployment at an all-time low, that means more people are working, and when more people are working, more people spend money. So now the Federal Reserve is saying, hey, we're going to raise interest rates. The market has to cool off. So cool off the market. So when the U.S. market usually is doing pretty good, around the world, usually not doing that well. For example, you look at what happened in Greece. The default in Greece. You look at the recent default in Puerto Rico. You look at the volatility in the Chinese market and the crashes that it's had. So, because the U.S. economy is doing well, and around the world they're not doing so well. But usually when you flip the switch, and back in 2008 when the U.S. economy wasn't doing so well, if you guys remember, Europe was doing pretty good and China was doing pretty good. So you can kind of catch up on a cycle. But all that is saying is, hey, I'm pretty much saying, I've been saying this for a while, that, market, not a crash, but a correction is coming. Which means the market is going to be declining here in the next 6 months to a year as interest rates are being raised next month. The U.S. market's stock market is going to be cooling off, which you're going to see the bear take over. It's going to switch the baton and the bear taking over. Now, today is August 9th, and the U.S. market, the Dow Jones, had about 6 or 7 days of straight declining Dow Jones, which kind of, give indications of people in the stock market trying to get away, right? So my thing is, what I've been saying for a while, is that you don't want to buy, name of the game is to buy low, sell high. When the U.S. market is at a high, that's not the time to buy. You go find things that are in the low. For example, places like Greece and Puerto Rico and China, right? So if you're going to buy anything in the U.S. market, make sure it's something that's paying dividends. Because what can happen is you can buy a stock at $80 right now. It can start to decline. And decline, it goes from $80 to $60 to $70 or whatever before it starts to rebound. Which is not a great idea to buy it at this present time. So let's forget all that. Okay, Prince, we know what's happening. I just want to paint a picture for you. So how can you profit from what you're going to do about it? So you come here, I'm looking at ETFs. And you go to research, go to products, go to ETFs. See that? Research, products, ETFs, right? It's going to bring you to this screen here. So you're going to leave it at all families. You're going to go to all groups. And you see this thing here called bear market, right? Now you can put in further things. You can get something with a low expense ratio, but we're just going to look, or whatever, because we only had one match for a bear market. A bear market means that this thing is going to profit when the market declines. We're going to hit view match, right? My internet is not, the fastest over here at the present time. But we're going to make do. It's fast enough. So this is going to be the only thing that pops up, right? Boom. It's HDGE hedge. So right now, when you look at it, it doesn't pay a yield, which is not the greatest thing in the world, but cool. But you can look down here and see the investment strategy. This is pretty much short selling domestic traded equities. So pretty much this is betting against the U.S. stock market. Now, when you look at it, over the last year, it has dropped 7%. Over the last 3 years, it's dropped 23%. Let's go here to the charts. The stock symbol for this is HDGE, so you can look it up yourself and make your own judgments. So we're going to look back over the max. I think it just came on the market in 2011. So as you can see, this has been steady declining, then declining, then declining. Why has it been declining? Because the market has been going up, right? The market has been going up. This is going to decline as the market goes up. As you guys can see here, throughout the week, on Tuesday, Wednesday, Thursday, and Friday, on Thursday and Friday, it starts to make money. And what it does is, as the market declines, it will make money, right? So that's one way you can look at it. Another way is, when interest rates rise, who makes money? Banks, right? So, Federal Reserves, they raise the interest rates, which means that banks are going to raise interest rates on houses, cars, other things like that. So the money that is lent out, the financial industry is an industry that can profit. Now, how can you put yourself in a situation where you can profit from this? Let's go here. Let's go back to ETFs. Where am I? There we go. Research, products, ETFs. We're going to kind of go through the same thing that we went through the first time. We're going to say all families, all groups. And we're going to go down here to where it says financial. Did I pass it? I don't think I did. There we go. Financial. So as you went here, all groups, financial, you have 28. You can go in and put other things if you wanted to, but we're just going to take a quick look. So you have different financial industries that you can, not industries, but different financial ETFs that you have. So we're going to take a look at XLF, right? The financial sector of the Spider Fund, right? This one is pretty cool because it offers a little dividend, which you can kind of break that down as well. But I'm not going to read this one all out together, but this is a way you can put some money in. Right now it's $25 each, to where when interest rates rise, this could be a ETF that can do pretty well for you and collect a dividend. So that's one thing that you can see. Hey, when the interest rates go up, the financial industry will probably make some more money. Also, you can look at the people who hold money, because there's always a real quick nugget is, when the economy is down, the king is the person who has cash. Cash is the most valuable asset, because that means that most people don't have cash. And when most people don't have cash, the person who has cash can lend out money. Because you look at it this way, let's say somebody who buys a lot of stocks, right? And when the market declines, that person don't want to sell that. They don't want to liquidate, which means sell all your stocks off. You don't want to sell all your stocks off, because that means that you're going to lose out. So that person may go out to seek more cash so they can buy things at a lower value. So when you go to seek that cash, the person who has cash is king, right? So when the market is down, the person who has cash is king. When the market is up, the person who has cash is not king, because usually money is cheap and people already have a good bit of money itself, because their stocks have appreciated in value. So I don't want to make the video too long. I don't know what it's at now, at the time of it right now. But hopefully you learned tonight this video. Hope you got something you can take away, a philosophy or something. Don't forget to like, subscribe, comment, and share. Until the next video, you guys be safe.